Dividend cuts can ruin your passive income goals. How can you best avoid dividend cuts? It is really pretty simple yet difficult for many. I see too many investors take risks with low quality companies with extremely high dividend yields such as AT&T and then get pissed when a company like this cuts its dividend. Really, they should have known better. It's like buying the lower quality product with high quality expectations. The product breaks and then you end up having to pay more as you give into the higher quality product in the end, paying more money than if you would have just bought the quality in the first place. It's a similar concept with stocks. You buy low quality companies with a shiny dividend yield, but then the dividend gets cut. The stock performance tanks and you end up selling at a loss because it's a never-ending downward spiral. Then hopefully you end up buying into quality stocks with a lower yield maybe, but that healthier payout ratio, solid financials, a growing dividend, and a stock that outperforms. People are naturally attracted to risk, those higher yields, but many don't factor in the long-term investing outlook nor the quality of the investment. They just want the cheaper product or the higher yield, low valuation stock, regardless of a company's fundamentals. Let's take a look at a list of 10 stocks that have cut their dividends this year. You'll see Intel cut theirs by 65.8%, Taiwan Semiconductors 21.5%, VF Corp 41.2%, USB 64.2%. We have other companies like GSK 36.95%. We have a 78.9% there for WY, so on and so forth. Now let's look at two of these companies and their stock facts. This is my new label I created. I just did a video last week if you want to look at the introduction of it. And let's see if there are any red flags that investors should have paid attention to that may have provided a forewarning about an unhealthy dividend and poor financials. So we're going to look at Intel and VF Corp. Now they have poor fundamentals. You just look at Intel, they're behind the race of their peers. It's just awful. VF Corp has been underperforming for a long time, but investors hang on to hope that it will recover, but usually these companies never do. And I see this happen. People think, gosh, this stock has gone down so much, it has to bounce back at some point, but yet it goes down another 50%. And then they say the same thing, and then it goes down another 50%. And they quickly learn that this is something that may never end, may never be in the green for them. Who knows, it could go all the way down to zero. Company can go out of business. So Intel has been in the red for a long time. You just look at its stock chart. And I bet this whole time investors said it has to turn around soon. It'll be different this time, as they ignored the fundamentals and poor financials of this company. So let's take a look. Intel and VF Corp. Now, the one thing you'll notice, if there's an NA at the price per earnings, that's probably because they're negative, so it's not even going to show it. Of course, VFC, their price per earnings is really high to 313, which means that their stock price has probably gone down so quick, so fast, it shot that up. Of course, the last 5 years average, we'll see with Intel, it's been below 12.07. And again, that's what is attracting investors. They just see a low PE and they're automatically there. Now the price per operating cash flow ratio, they're both low, at one at 14.31, one at 20. So let's see what happens when we look at their cash flow growth over the last 5 years. It's been very small with Intel at a very poor 3.49%, but look at VF Corp, negative 17.53. That's not cash growth, that's cash trash. Now revenue, we'll see they're both negative. Intel is a lot higher in the negative range at negative 27.4. VFC is negative 1.94. The revenue growth over the last 5 years has been virtually nothing. Gross margins are okay, but you put in that return on equity and you'll see negative number for Intel and barely anything for VFC at a 3.74. Now let's look at debt. I will give Intel a little bit of a positive here. Their debt's not bad. Their total debt to assets is a 23.53. Their debt to equity is a 41.86. But if we go over to VFC, their debt to assets is above 50%. That's what I like to put my benchmark at. Anything below that for the debt to assets I think is great. Anything above, you're kind of playing with fire. Debt to equity is extremely high at 229.12. That's unsustainable. If we look at their dividends now, Intel cut their dividend, that 65%. Their yield is now a very low 1.57%. No longer is it an attractive yield. Their payout ratio, because of the cut, just sent it into the negative 74, but don't let that fool you that it's something positive. It is not. Their 1 and 5 year growth, look at that. The 1 year growth does represent that 65% cut they did, and their last 5 years is negative 16. You have no growth in their dividend, neither for VF Corp. Their yield is at a nice 6.12, and people will see that and buy in. But look at that payout ratio. That's unsustainable, 387.1%. Of course, we see the 1 year growth is negative 40% because of the dividend cut. Last 5 years, negative 8.14. So yes, plenty of red flags with negative revenue, high debt, or the payout ratio that's unsustainable. There is, negative cash flow. Just lots of things that if people just took even a few minutes to look at something like this, they would quickly just put them aside and not look at them again. But people, again, like to only look at maybe the PE and the yield, and that's it, and they buy in, and it turns out to be a loss, a huge negative for their portfolio. Now let's look at a quality company with a low risk of a dividend cut. They have a growing dividend, and they're an outperformer, and that's Microsoft. Some say it's expensive, but that has been said every single year, probably forever. But look at the quality and returns it has provided. We see here, yes, its price per earnings is higher, trailing 12 months over the last 5 year average. I do think it's overvalued right now, probably not the best buying time, but overall, you buy now for long term, you're still, I think, buying a high quality company that will provide you great growth. Their price per operating cash flow ratio is higher at a 29.89, but they back it up with the last 5 years growing at their cash flow grows at a 24.67. Now their revenue, like most companies this year, has slowed, trailing 12 months to 7.81, but the last 5 years has been great at a 17.13. Definitely a change from the negative growth we saw with the other companies. Gross margin is at a very high 75.25. Return on equity is high at a 38.46. We saw a negative and I believe barely a 3% on the other companies. Now their debt is very attractive because it's not high. Their debt to assets is low at 21, and their debt to equity is low at a 43.57. It could be lower. With a company like Microsoft, with all the cash flows, they can pay this down pretty easily. Now the yield, 0.82%. Luckily, I got to buy in over 1% when it had its dip in the low $200 range per share. Right now it's 326, as you'll see. But regardless, they have a very healthy payout ratio, a low one at 30%. And look at the 1 and 5 year growth, around 10%. They're growing their dividend 10% per year, where these companies are cutting them. And I bet you before that they were barely growing, if at all. So now let's look at 2 companies in my portfolio that I think are at risk of dividend cuts. Let's look at my portfolio performance quickly. It's at a 7.35%. It's been very good. The technology sector has really been booming, entering kind of a bull market. So I'm up $4,300. Now, you will see a clear distinction between my low quality stocks and high quality stocks simply by what is in the red versus what is in the green. That is just, it's interesting how that worked out. But yes, any stock in the green is high quality. Anyone in red is low quality. It just worked out that way. It's kind of funny that it did that for this video. But I see 2 that are at risk of dividend cuts, and that's AT&T and 3M. 2 in the red that pay dividends, the other 2 don't. My early investing years, I made poor choices as I was attracted to that yield and paid attention to nothing else. So let's look at their stock facts quickly. 3M has a low price per earnings right now of 10.35. People will see that and buy. We will see here that the price per operating cash flow is low for both companies, 7.68 for 3M, 11.53 for AT&T, but the last 5 years definitely shows why they're cheap. 3M only grew by 3.51%, where AT&T has a negative 28.11% growth over the last 5 years. That's awful. Revenue, both in the negative by 5.5%-ish. Revenue growth over the last 5 years is either barely positive at a 1.57 or in the negative at 5.57. Gross margins are okay. Return on equity for 3M is actually decent. I give them some props there. But look at AT&T, negative 7.74. Now, the one thing I will say is their debt to equities are unhealthy. 3M at 116.43, AT&T at 144.7. Now let's look at their dividends. Both have attractive yields, around 6 to 7%. But look at the payout ratios. 3M is high at 62.18. I'd say if this gets into the 70% range, they're going to be looking at cutting this dividend. That's just my opinion. And AT&T, because they just cut it, it threw it out of whack. It's a negative 89. But look at the 1 and 5 year growth. For 3M, it's been virtually nothing, 0.67% over the last year. and 1.98 over the last 5 years. AT&T has been 0 over the last year and negative 11.11. And you look at their stock charts, they've gone down massively with these reductions in their dividends. It's just done nothing but create losses for investors. So I hope this helps you as an investor see the importance of a company's financials and fundamentals. Don't fall into the dividend yield trap. That's what it's called, where you're just attracted to a high yield and you don't look at nothing else. You think, man, I'm gonna make a lot of money, but you end up losing a lot of money. And that's what the dividend yield trap is. You need to avoid that. Buy high quality companies. Over time, especially if you're a long-term investor, the yield might be low now, but as they raise it, like Microsoft, 10% per year, that's gonna grow pretty quick. And when you come to retirement, that will be a great, solid, healthy dividend that you'll be collecting, not at risk of being cut. I know a person that invests in the highest yield stocks and investments possible just because they want the highest passive income. That's very risky. I believe it probably works out for less than 1% of those out there, and you're gonna lose money. So let me know what dividend yield traps you have in your portfolio. Mine are AT&T and 3M. And if you have any advice for anyone out there that I failed to mention in this video, I also have a quality checklist I follow that I've shared with other videos. I'll maybe do another video on it, but it looks at other things like the moat, the management, the products that they produce, so on and so forth. But really simply, you look at something like my stock facts chart, it can easily tell you the health of a company financially and whether that dividend yield is at risk or not. So thank you guys for joining. I hope you guys have a great day, and we'll see you next time on Mark Arnold's Finance.